Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week we're going to take a hard look at the major challenges before the Reserve Bank of India now that it has a new governor, Urjit Patel. I don't know how many of you noticed, but I don't care to use the word tasks before the RBI rather than the governor Urjit Patel. There is a reason for this. Over the past 3 years or so, there's been an unfortunate tendency to equate the RBI with the governor. This is not only a rather simplistic view of how the RBI actually functions, but it also has the unhappy consequence of personalizing the office of the governor in a way that is not necessarily in the best interest of any institution, more so when it happens to be the central bank of the country. Of course, that danger is likely to be much less now that we have a monetary policy formulation has become the domain of a 6-member monetary policy committee rather than being primarily that of the governor. Even so, perhaps it's time for us to focus on the institution rather than the man or the woman at the helm, because it is the institution rather than the individuals or the head that is important when one thinks in terms of nation building. And that's what I hope to do with the help of my excellent panel. Ashima Goyal, Professor IGIDR Bombay, and Pradeep Kumar, former MD, State Bank of India. The Monetary Policy Framework Agreement might have made RBI an inflation targeter, but the RBI is also responsible for a host of other things which are no less critical. The RBI website lists 10 other functions apart from monetary policy: regulation and supervision of banks, banker to the government, management of public debt, note issue, financial stability, foreign exchange management, and so on. So over the next half hour or so, we're going to try and parse these for you to try and identify the major challenges before the RBI. Ashima, you've been a member of the Technical Advisory Committee TAC on monetary policy that offered advice to the RBI governor under the earlier dispensation. So my first question to you is the new monetary policy framework likely to reduce the role of the RBI in monetary policy formulation, and to such an extent that the first challenge before the bank really will be to ensure that the policy carries its imprint and does not become subject to political pressures, because 3 of the members of the MPC will now be government appointees, and though the governor has a casting vote, that's only in the case of a tie and ideally should be very rarely exercised. Ashima?
Yes, I think that at present the constitution of the committee is such that the RBI will continue to play a major role, and hopefully the government will appoint independent experts rather than political, people with political views. Because the way these committees work throughout the world is there's a very data intensive process they go through together prior to casting their votes. And the RBI and its departments will be responsible for putting together all that data and for guiding these deliberations. So this, and as you were saying, it's the strength of the institution. The RBI has a very good research department, has a long history of research in these areas, has access to a lot of data, and therefore this will be an essential part of the inputs to the committee which will go into making their decisions, and therefore the RBI will be responsible for all this background work. Their role is dominant there. Even in the committee they'll have a dominant position. And we have to see how the committee will function. If it's a sort of gradual transition from the TAC, then the RBI will continue to play a major role, but it will be more transparent what the committee's individual members' views are. I think that debate will be out in the open.
Pradeep, would you agree with Ashima, or has the RBI become less relevant when it comes to monetary policy? Because the reality really in a country like ours is that government appointees are seldom as independent as we might wish them to be. So also there's the problem that there's been a distinct change in the manner in which the governor and the deputy governors have been appointed. Because if you see that earlier in the case of deputy governors, the governor's voice was very important. And now you see that the governor's voice counts for much less. Does all this smack of the institution in some sense being downgraded, as it were? Or is it better to have clearly defined systems and procedures? And as a former banker who's been at the receiving end of RBI's sometimes whimsical approach to monetary policy, do you think the new system with the MPC in charge of formulating monetary policy changes the equation between banks and RBI, and banks in particular will have much greater clarity about the policy trajectory? Pradeep?
Yeah, I think a committee and a structured approach is always much better. The views of 6 individuals are going to matter, not the views of only the governor and the internal RBI system. There are 3 appointees of the government. I hope, as Mrs. Goyal said, they would be technocrats, not bureaucrats, and they'll be really be independent. Of course, RBI governor still has a casting vote. So in a case of a tie, when maybe the RBI and the government representative think differently, ultimately it's what RBI thinks will come out. But I think this committee will ensure there's greater transparency. I trust everybody's views will be recorded and will be available for posterity. Why a decision was taken? Like I think the Fed, it is all the minutes are released subsequently. I hope such minutes are also released subsequently, so people will get to know and bankers will get to know why a decision was taken and who were for it, who were for against it. I think a structured approach is always much better. I still agree with Ms. Goyal what she said. I think RBI still, I think the views of RBI ultimately will matter. Of course, the data, the quality of input given to the committee, of course, will have to matter. And the other good thing is, I think the mandate given to the committee is price stability, keeping in mind the objective of growth. I think in the last 3 years, the governor forgot the second one, the objective of growth. He was single-mindedly devoted to the cause of price stability. So when we have a clear mandate and there is a structured approach to it, I think everybody, the country will benefit by it.
Okay, so both Pradeep and Ashima are hopeful that it certainly will increase transparency, particularly if the votes are recorded and made public, even if after a lag. But Ashima, it's not just in the matter of monetary policy and appointments of governor and deputy governors and parity with their counterparts in bureaucracy that the RBI seems to have been brought down a notch or two. Even in the matter of appointment to the bank's central board of directors, there is some of the same lack of seriousness on the part of the government, if I may put it. For instance, the central board now has only 6 directors, as against the 14 mandated under the RBI Act. And with the exception of the Eastern Board, none of the local boards has any directors. And this is from a government that talks of financial inclusion and cooperative federalism. So could it be that the government in some sense doesn't take the RBI as seriously as it did before? Or am I drawing too hasty a conclusion? Ashima?
Let's hope the conclusion is hasty and these gaps will be filled soon. The government should certainly wake up to the importance of good institutions and their importance for India's credibility abroad. I think this government is very sensitive to that. So I do not think they will try to systematically downgrade the RBI. It might just be neglect. They need to be reminded that they have to fill these vacancies. And I think in the media there was a lot of speculation when it became clear, when there were doubts that Raghuram Rajan would continue. There was speculation that the government was trying to impose its will, that it wanted a more accommodative governor, etc., etc. And therefore it was downgrading the RBI. But they chose continuity, right? They chose the deputy governor who had written the inflation targeting report and who therefore was committed to this new framework. So therefore I think it's better not to impute such motives to government. On the whole, they seem to want to strengthen institutions and to maintain continuity when things are going well and the institution is delivering.
Let me toss that same question to you, Pradeep. Ashima says it may be just a question of bureaucratic lethargy. But does the solution, in fact, given if it is bureaucratic lethargy, does it lie in having a bipartisan body like, say, the Parliamentary Standing Committee on Finance? Should they be in charge of shortlisting names so you don't have this kind of impasse? Also, I'm sure you've experienced the ignominy, quote unquote, of bureaucrats in the finance ministry, some of whom who have very little knowledge of banking, sit in judgment of who is best suited to be elevated to senior positions in public sector banks. So can we think of a better system so that institutional independence is not compromised and we get the right kind of people, whether it is in senior positions in banks or as independent directors in the banks or in the RBI? Pradeep?
I think, see, I agree with her that I think the present situation is due to bureaucratic delays. Like whenever government is involved in appointments, we've always seen that there have been delays, except perhaps in the case of the RBI governor, they have been able to do it in a time-bound manner. What other mechanisms? I do agree the bureaucracy's knowledge of the workings of the RBI. I do not know whether they are the right people to choose the directors on the board of RBI. I think we should have a more structured mechanism to it. Maybe something like we have a banking board bureau which will control public sector banks. Maybe they can have something similar, some other body which will make all the appointments so that the bureaucracy is taken, the power of the bureaucracy is taken away. Maybe we'll have to look at the way things are done in other countries like the US, where there is some involvement of the legislature or elected representatives in selection of the members of the Fed Reserve and things like that. I think we should put in a system which is fair, transparent, and accountable to the nation.
Okay, so we do need to have a better system in place rather than leave it entirely to bureaucrats and wait for government to shake itself out of its lethargy. But on that note, let me slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the tasks before the Reserve Bank of India as distinct from the tasks before the governor, because institutions are really much more important than individuals. So it's important to separate the institution from the individual, and we're trying to focus on the tasks before the Reserve Bank of India. Ashima, let me now shift to some other issues that are seldom discussed, and these relate to the other functions of the Reserve Bank of India. Now that price stability has been elevated to being the primary function of the Reserve Bank of India, albeit with growth, what does that really mean for the other functions of the bank? How will it affect the character of its bank? Does it cease to be a full-service central bank with responsibilities for regulation and supervision of banks, foreign exchange management, financial stability, internal debt management, and so on? Given that many of these functions overlap and have important implications even for monetary policy stability and formulation, can we really put them in watertight compartments, or should we think in terms of a more holistic system? Ashima?
Yes, I agree with you that these other functions are critical and equally important, but unfortunately in the media, partly because of the importance of inflation for the public and the new inflation targeting framework being put in place, the focus has been on inflation. Controlling inflation is the prime goal of the RBI. But that is certainly not the case. Even narrowly considering monetary policy, an inflation targeting framework is misunderstood. What we have adopted is flexible inflation targeting, and the idea is to give a clear sort of objective of the RBI's action. But those actions come out of knowledge of all the interacting parts in the economy. So therefore things like growth, etc., financial stability, everything is part of this whole pot boiling together and delivering an inflation. And so you have to act on all these things to achieve your inflation target. It's just a sort of communication device, and you cannot afford to neglect either financial stability or growth in order to deliver your inflation target. And the other departments and their functions are equally important. There is an issue of macro-prudential policy and its alignment with inflation targeting. I think the Bank of England has 2 committees which interact. I think this is an area being explored internationally. And the RBI has actually done very well with its use of dynamic provisioning and so on in terms of maintaining stability. This is being kind of widely adopted abroad now. So in a sense, the RBI was a precursor for some macro-prudential policies. And then one of the major sort of areas where there's a lot of innovation, which is financial technology, digital payments. RBI is the regulator there. And this is going to be a major challenge and a major area where they can deliver financial inclusion, reduce transaction costs, increase the penetration of the financial sector, improve the intermediation of savings, and in general contribute to growth in all these ways. And RBI will, and its regulatory functions can be streamlined, to reduce transaction costs, to improve access to finance, and to deliver many safe kinds of financial innovations in the future.
Pradeep, would you agree with Ashima that the monetary policy framework does not really alter the character of the Reserve Bank of India, and it's not to its detriment? Also, much of the neoliberal thinking that has influenced the monetary policy today, frankly, has relevance to my mind to developed countries where you do not have the fiscal dominance of monetary policy, which is quite unlike what you have in India. Here, the reality is that the government necessarily has to borrow large amounts to finance development, and the RBI necessarily must take that into account, whether through financial repression that could take the form of mandated liquidity requirements like SLR or priming the market to ensure that government borrowing program goes through. So can we really look at all the departments together, and does the new monetary policy framework risk changing the character of the Reserve Bank of India?
No, I will agree with her that I don't think there is that the formation of this monetary policy committee is going to affect the other regulatory, supervisory or the management of the debt or forex of the country anyway at all. It's only one part of the only one role of the Reserve Bank. The monetary policy has been put in a structured format. Ultimately, monetary policy will be affected by all that is happening in the whether it's happening in the fiscal world or the commercial banking world. So I don't think it's going to affect the way RBI is working. But of course, our country, I agree with you that the Reserve Bank of India has to take into account that there is a huge fiscal deficit in the country, which is being financed primarily by borrowing from the banking system through the concept of SLR. So this we cannot wish away. And I always believe the problem we have had in the last 3 years was there was less and less of communication between the government and the Reserve Bank of India. I mean, Reserve Bank of India took too seriously its independence and perhaps did less communication or less coordination with the government. I think for the country to grow and prosper, I think both the government and the RBI have to go hand in hand to resolve the issues facing the country.
Ashima, Pradeep spoke of the need for monetary policy and fiscal policy coordination, and the fact is that any monetary policy that is not rooted in reality is bound to come a cropper. We saw that happen over the course of the last 2 years when the RBI cut its repo rate but failed to understand that transmission cannot and will not happen in the absence of not only adequate liquidity but also because Indian banks are dependent on retail rather than wholesale deposits, and since these are contracted at fixed rates, theoretical concepts like the marginal cost lending rate are really meaningless. Do you think that with the bank being made a formal inflation targeter and focus shifting to price stability, its policy will become even more divorced from commercial banking, and this could have serious consequences not only for growth but also for monetary policy itself, because banks with their fractional reserve system are very much part of the multiple credit creation process, and bank money is part of the broader money supply M3. Ashima?
Yeah, Mythili, that's an excellent point. I really agree with you. And I hope that the RBI will not take this inflation targeting business in a very orthodox manner, the way it is applied in developed, in mature economies, because in our economy it's going to work very differently. And I agree with Pradeep's point that the coordination with the fiscal authority is very, very relevant, because a lot of inflation is driven by supply side factors, where what the government is doing is important, and therefore if they're taking steps to bring down food inflation, which has been a major inflation driver, the RBI can afford to decrease rates. But at the same time, the RBI has a role in anchoring household inflation expectations through the inflation targeting regime. So both monetary and fiscal policy have to work together. Just demand tightening hurts growth more. I mean, raising rates and the tools available with the RBI, or liquidity, tightening liquidity. Yes, this keeping liquidity too tight over the past 2 years was really a mistake, because there was a view that this transmission works better if you keep the economy in the injection mode, keep it but that seems to, in retrospect, it seems it works better in a tightening cycle, not when you want to start accommodating. So one reason banks did not pass through was partly that liquidity was tight. And second, also the NPA issue, and here again it doesn't seem to have been handled very well, because credit growth has just faltered, and you cannot have transmission if you don't have credit growth. So whether it was because it was done at a time when rates were rising, or there was not enough injection into banks to take care of their stressed assets, because you need a combination of measures. It was the whole stressed assets were partly due to external factors, due to delays in infrastructure clearance, etc., due to a push for infrastructure that public sector banks are forced to participate in. So you cannot put the whole onus on banks. They have to recognize and restructure without an infusion of funds, an adequate infusion of funds, or other kind of incentive mechanisms to get credit flowing. So it is very important to have a heterodox understanding of how inflation targeting is going to work in India, and not have a textbook approach, which is not going to work in an economy like India.
Pradeep, I'm sure that was music to your ears. But how do you see
Yeah, I
RBI's relationship with the banks, particularly public sector banks, evolve over the coming years? The fact is that banks, and again public sector banks in India, are excessively burdened. Apart from CRR, SLR, priority sector lending, they also have to step in and lend to infrastructure projects, chip into government programs like Jan Dhan Yojana, etc., many of which are loss-making propositions. What can the RBI as a banking regulator do to ensure that banks are allowed to function on commercial lines and are not burdened excessively by socio-political considerations that ultimately lead to being burdened with NPAs? Can it take a more pragmatic view also on Basel rather than telling banks to be Basel III plus? Could it, for instance, take a leaf out of the books of the Bank of England, which allowed relaxations to British banks after Brexit? Pradeep?
No, I fully agree with you on Basel. I don't think we need to be more loyal than the king. Our requirements of Basel for Basel III are much more than what Basel wants. We are a capital-starved country, and in a capital-starved country, we cannot have a regime which requires much more capital than is required internationally. So I think the Reserve Bank of India has to look seriously at what to do with the Basel ratio. I'll give you another example. We have this LCR. LCR is required because there is no SLR in other countries. In our country, we have an SLR. Why do you have an LCR on top of it? Or recognize that that all SLR assets are high quality liquid assets, HQLA. But now RBI said only part of it can be treated as HQLA. Why this very small, very steps which are very halting steps? No, you please accept the fact that we have more than 20% SLR, and that can be treated as equivalent to LCR. So I think we require innovative solutions. Yes, I do understand that we have to be part of a global framework because banks work in a global economy. But yes, the RBI has to understand the differentiation, the realities of India, and act accordingly. If Bank of England has done something for UK, but slightly different from what Basel wants, I think RBI can look at it. And even some of these, I think, risk weights are much higher in India compared to what is internationally, what the Basel wants. So I think the present regime in RBI has to have a relook at the entire Basel requirements. Unfortunately, Basel requirements are coming when the economy is not doing so well, banks are burdened with NPAs. So I think the Reserve Bank of India should take a very hard look at the Basel requirements.
Absolutely. I think all requirements should be tailored to India's needs. Ashima, the RBI has been trying very hard to move the system away from a bank-led system and, to its recent directions. If you look at it, they're trying to push corporates to borrow from the bond market. It's only the latest example of resorting to the stick rather than the carrot whenever it suits its purpose. However, given that ultimately what is at stake is the safety of retail savings, whether in PFs and provident funds and pension funds or insurance funds, how advisable is it really to compel such a shift, especially in the absence of a supporting ecosystem? We're running out of time, so can I ask you to quickly be a little brief on that, Ashima?
Yeah, I think that developing markets is a good thing as long as they're complements, but it cannot be at the expense of banks. So you have to ensure that the banks are healthy, because for the majority of savers, their deposits, return on deposits, and as you are saying, need to be insured.
Pradeep, very quickly, I'm sure you also have very strong views on the RBI quoting the free market at times, and yet when matters don't go its way, as in the case of interest rates, it comes out with a very heavy hand. The latest issue of the London Economist calls it bank bashing and says throttling banks so that they don't binge and bust again is laudable if heavy-handed response to a recent mess. But the curtailing of bank lending presupposes that there's a thriving bond market will emerge, even though decades of efforts have yielded very little. If banks cannot lend and institutional investors prove unwilling to fund a corporate bond market, those companies will have nowhere to go. In effect, capping the size of companies whose capital structures the authorities disapprove of may not be very wise. Very quickly, your reactions to that, Pradeep.
I think, developing bond markets depend upon so many other things. Like we have, let us say, the other regulators like the PFRDA and the IRDA, which have stipulations regarding investments of these funds only in the AA rated securities. If that is so, what will happen to lower rated companies? Of course, the RBI has talked about partial credit enhancement, but again, the partial credit enhancement, the risk is on the bank. So
the banks,
the problem in our country is the pension funds and insurance is a very small portion of the economy. Unless they become very large and there are large funds available for investment, the bond market will not develop. Mandating development through fiat, I don't think it is going to happen unless insurance proliferation happens, pension fund proliferation happens and there is a competition amongst funds to invest, I don't think the bond market will develop. All these restrictions that RBI has put on the amount of lending to a single corporate by a bank in the next 3 years, cutting it down, will only ensure that the growth will slow down, especially in the infrastructure sector. I don't think it is good for the country. I think again, as one of the RBI governors has said, I think RBI has to keep its ears to the ground. They must understand the reality of India and not treat it like any other country. We are not the United States of America, where there are hundreds of pension funds and insurance funds.
Absolutely, Pradeep. I couldn't agree with you more. Development cannot be mandated, but I'm afraid we've run out of time completely, and so we'll have to end this discussion. Thank you very much, Ashima, as well as Pradeep, for joining me in this discussion. Hopefully, some of the media attention that was focused excessively on the persona of the RBI governor will now shift to the RBI and what needs to be done to strengthen one of India's finest institutions. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.